return on equity. We're talking about Goldman Sachs, Semaphore making some headlines, expecting it to drop very dramatically. What about the banks that we have reporting before the bell today?
Well, yeah, I think it's really not going to be banks' finest hour this quarter, right? Most of the metrics that we look for in the lending across the landscape are just not going to be good, particularly sequentially. I think lending will be okay year over year because of the sharp rise in rates. But, if you look at loan growth, certainly expect it to have slowed further here. The demand with higher interest rates has just moved down a bit. Net interest margins, banks are fighting a bit for higher yielding alternatives on deposits, having to pay up a bit more. So we expect to see some sequential margin pressure. And those loss provisions as well, right? Expected to be higher. We're seeing some, in particular, some worries in credit card.
I want to get to the net interest thing with you for a minute, but I do want to focus on this return on equity for the banks today. So big deal, small deal, is there one bank more exposed to an issue or a drop there?
Well, yeah, absolutely. We would expect Goldman Sachs to be among the worst here.
That's next week. What about today?
Oh, well, you've got probably Citi has been perennially a bit weak on return on equity. They're just having difficulty, converting profits here in this environment. Okay. Again, with the weak capital markets activity is probably going to weigh on them more so than at JP Morgan. Yep, or Wells.
So Citi's the ROE number where we want to watch ROE for at least for today. So I actually want to get to a chart that you sent me, some of your research that's really illustrative. We're going to show it in just a second. It's showing deposit levels for commercial banks year over year. And when you look in the recent years, it's really been a dramatic move down. And we're seeing, of course, recently a really dramatic move down year to date. Yields have declined since CPI. But you look at treasuries, really attractive yields. I'm looking at the 1 year right now at 5.3%, and it's really a similar story for money market funds. How does this hit the sentiment on the banks and also the metric you were mentioning, net interest margin?
Well, yes. So banks have, over the last year, obviously lost, between April 22 and 23, they lost about $1 trillion of deposits, 18.2 to 17.2 trillion. And much of that happened actually before the Silicon Valley crisis of confidence in deposits. So that is and if you look at the last 30, 40 years, deposits really have gone nowhere but up. So it's pretty dramatic. Higher yielding alternatives, again, moving people out of deposits. So yeah, banks are in a fight for deposits. The good news is that since April, we've recovered about 200 billion of that. So I think it's safe to say the the crisis of confidence in deposits is over.
We are seeing the slight uptick on the chart, but you're talking trillions and billions, not the same metric when you see that uptick. I want to ask you one more question. It seems to be just the central theme in the markets this year, AI. Are we expecting any announcements related to AI when it comes to the big banks reporting either today or next week? And how does AI play a part in the long-term narrative when it comes to investing in these companies?
Well, I don't think we'll see anything dramatic. I think banks have been certainly experimental with AI. They've been investing in a variety of things, how they interact with consumers, customers. You'll have the technology itself, but I think you have the robo advisors and things like that. So there is potentially changes in the landscape to banks, but I don't think it's going to be dramatic, at least in the near term. But we'll hear more about that, I think, in the coming quarters.